The carry trade is one of the most famous types of institutional trades. But is it possible to do a carry trade with a MetaTrader expert advisor? That is what we're going to be diving into in this video and showing you the strategy which I took to apply the carry trade principle to an expert advisor. This video is sponsored by Prosperity Algo and our free Golden Time Bomb Expert Advisor. Do you want to make 100+% annual returns through automating the London breakout and the opening range breakout? Then click the link in the description. So the carry trade is a very famous institutional type strategy, and carry really refers to getting paid money without necessarily having the asset needing to appreciate. And the most famous type of carry trade is usually an interest rate or an FX carry trade. And the classic example is you borrow a currency, you borrow in a currency that has a very low interest rate, and you use that to buy a currency that has a high interest rate, and you essentially make money off the interest rate differential. So the most classic example is that the yen has always had very, very low, or at least in recent history has had very, very low interest rates. So many people, including even just ordinary Japanese citizens, go to the bank, they borrow lots of money in yen, they then convert the yen to another currency like the New Zealand dollar or the US dollar, and then they hold US dollars in a US dollar bank account, and they get paid interest on that. They can then use the interest on their US dollars to then pay their Japanese yen interest, and they essentially capture the difference between those two interest rates as a profit. And this actual trade is very, very popular with institutional traders, particularly in emerging markets currencies. So like the lira carry trade is very popular, as is the Mexican peso one, particularly as like in more higher risk, more emerging markets economies where yields tend to be quite high, you're able to capitalize this on to make quite a good amount of profit using this strategy. And essentially, as you guys know, with CFD brokers, we have to pay swaps. Sometimes, though, we also get paid swaps. And what swaps are essentially meant to represent is it's trying to get this concept of borrowing in one currency or borrowing one asset and then receiving payment in the other or having to pay in the other. And it's trying to put this in a very easily digestible number as you're trading a heavily leveraged contract. And essentially, though, we can essentially get paid swaps if we hold the right kind of asset. So in this experiment, I wanted to see, could we essentially use swaps, but positive swaps, to create a positive and a high expected value trading strategy? And specifically, my first thoughts were around the concept of the triple swap. And if you guys know, if you've been trading for some time, on Wednesday or Friday, depending on the asset class, you get paid not one time swap, but actually 3 times swap. And inversely, if you happen to be short or long, depending on the pair, you sometimes have to pay your broker 3 times what the normal swap would be. And this is done particularly in Forex and metals to take into account the weekend holding periods. So they essentially charge you for the weekend on Wednesday. So my initial thoughts were, is it possible to use the Wednesday triple swap to actually have a very profitable trading strategy? And what I did is I first went to the Market Watch and I looked for a few different assets, many of which are my favorite to trade, including gold, indices, and a few different currency pairs. And I looked for different positive swap values. So here we can see that if we short gold, and in that case we would be shorting gold, so we're borrowing gold and we're holding US dollars, this is what our swap would be. So we're essentially being paid interest on the US dollars because our borrow cost of gold is lower than the yield we are getting paid on the US dollars. And it's much easier to see here for yen. We can pull up the Japanese yen, and we can see that our positive swap here is $8.2 per lot, or it's per 100,000 USD lot. And that means that in this case, we are long US dollars. We're buying US dollars and we're short yen. So we're borrowing in yen. So it's a very interesting statistic here. And we can use this as the basis of our carry trade strategy, because this tells us how much are we going to get paid from any of these assets through swaps. And then I essentially took some of these assets and I did a carry calculator. And I was looking to see, like, based on the assets, based on the size of the asset, based on the size of the lot, if we essentially divide the swap, so how much we're going to get paid by a swap, by the principal, it'll tell us what that move would be. And specifically here, we can also see that if we have a triple swap, those moves start to get a lot more significant. So if we take, for instance, the NASDAQ, and we just do the simple math here, we can find that if we take the positive swap, if we assume a triple swap, over the size of the lot, we're going to make around a 0.2% profit, which is actually a rather significant move. And if we contrast that to gold, gold is quite small, but I'll get to why there's still some advantages to this in a second. And I also took into account the spreads and the commissions for the assets, seeing us essentially what would our net cost be from actually receiving the receiving the swap, once we deduct swaps and commissions. So it was a very interesting approach here. And what I found is that ultimately the best in theory on paper would be the US equity indices. However, there's really one major kind of caveat here. US equity indices get paid the triple swap on Monday because you have to essentially hold over the weekend, or essentially Friday. So this is rather challenging, right? Because the swap is charged on Wednesday and typically you get paid on Thursday. So here with the indices, the swap is charged on Friday. So my assumption, I've never actually done this, but my assumption is that you are paid on Monday. Correct me if I'm wrong, I might be missing something, but this was my interpretation of the data. And this would imply that you need to hold over the weekend. And that's obviously really bad, because even if, yes, you are getting paid, if you have to hold a highly levered position to get paid a swap over the weekend, this can be really terrible because the indices can move quite a bit over the weekend. And that means that you're still taking a directional bet. So you're not necessarily getting paid based on just the swap, you're getting paid to provide liquidity and take on a fair amount of risk over a weekend holding period, which is quite a bit riskier. So my focus here was on essentially the assets which are going to get paid on Wednesday. And the reason why I want to do Wednesday is because the actual holding period of the asset to get paid the swap is as short as possible. So that kind of helps us eliminate all of the more equity indices and gets us down to metals and forexes. So why are metals, in my opinion, superior to forex? And this is simply because Forex does not have that defined 1 hour closing period. They simply have the market closes at 5 p.m. Eastern Standard Time, and then market opens back up again in a couple minutes. However, spreads tend to be insanely high during this period. It's the spread rollover time. And during these periods, you can't really get out of a position. However, the price still moves during these periods. So during that 1 hour, you're still at the mercy of price fluctuations without being able to easily exit your position. So in my mind, that kind of eliminated all of the different currency pairs because all of a sudden you're unable to kind of liquidate your position quickly. So this really leaves us with gold. Gold is almost the perfect asset here, despite actually having the lowest swap, simply because you can literally enter 1 minute before the market closes and sell 1 minute after the market opens, typically with reasonable spreads. At the same time, you only have to hold over a Wednesday evening and sell on Thursday market open, so Wednesday at 6 p.m. Eastern Standard Time. So that means that our actual total hold period is extremely short. So that's why gold seemed really interesting to me. At the same time, the spreads on gold are very modest, so we're able to get in and out at a relatively reasonable cost, and we're able to use very high leverage with this approach. So I took this and I ran a simple back test here, and this was from 2020 to 2025. And this back test looks amazing, but there are some caveats here which I need to point out in the interest of transparency, and because obviously it's not as rosy as it looks. But all I'm doing here is I'm essentially buying 1 minute before the market opens and selling 1 minute after the market closes. So that means that, so 1 minute after the market, 1 minute before the market closes I buy, and then 1 minute after the market opens, or a couple minutes after the market opens, I am selling. So what I'm doing is that this is essentially the buy time and the sell time. And if you look at the back test here, you can also see that essentially I'm getting paid a lot of money in the swaps. So even if I'm losing occasionally because I'm either hitting a stop loss or because the price moves, I'm just like capturing significant profits from the swaps. And that's essentially how I'm getting paid. And the actual like directional movement is a net loss. I'm losing around, over the period of these 5 years, around $150,000. But I'm making close to $300,000 in terms of profits. So you're essentially making money more off swaps than you are off of directional movements. An absolute massive caveat here is in terms of backtest accuracy. My understanding is that the swaps don't actually update historically per the backtest period. So that means that, unfortunately, throughout this entire period, we're not necessarily going to see an update in the swaps. So what that means is that we're probably making more money during certain periods because right now the US dollar is paying a fairly high yield relative to historic times. Therefore, most likely the backtest is looking quite a bit more rosy than we should expect because we're using today's data through the entire period in order to actually see the graph. So here, the swaps were likely not as high as they are here, right? So that's just one thing to keep in mind. That's why we're turning $1,000 into, I think it's like $150,000, so yeah, $126,000. So like obviously, this is an insane return, but there are some things going on here which is making this look more rosy than it should be. One of which is obviously that the swaps are higher than, or at a relatively high point now. So if we use that over the entire backtest, we are kind of giving ourselves a pretty sizable unfair advantage there. So that's kind of what's making this look super rosy. And the other big factor here is that we are significantly exposed to black swan risk. Because for this to work, we're essentially going in with an extremely high amount of leverage, with an extremely tight stop loss right before the market closes. And that's how we're able to do this, because the actual swap payments, if you can go back here, are very small. So for this to work, we need to use a lot of leverage. And that means that in the event that there is a big move between market close and market open, we can have some pretty massive drops in the equity curve. And that's why when I did this thing, I actually put in place some filters, including a high impact news event filter and an ATR filter, meaning that if we're in a particularly volatile afternoon period, don't trade. And at the same time, if there's some high impact news going on, don't trade. Because I found that the highest risk events were after an afternoon US news release like FOMC, which can actually cause some significant late day volatility. So that was essentially the approach I took here. And it shows that, yes, there is a viable strategy here. And it's actually rather interesting that just by holding the asset, you can get paid very significant amounts of money. The downside is that there is massive amounts of negative skew, as it's called in quantitative finance, which shows that you could have some black swan events that like destroy 2 years worth of profits. And at the same time, you also have to consider the fact that this is a very rosy backtest because of the fact that we're using a relatively high swap payment over the entire period. But there's still definitely something here. So I'm actually now forward testing this exact expert advisor for a little bit just to see what it looks like. I think it's quite an interesting approach, but definitely also higher risk. But really my takeaway here is what I'm trying to do now is look at alternative ways to incorporate more institutional style strategies in a Forex expert advisor context. So drop me a comment if you found this video interesting. It was a bit of a longer one today, and hope to see you guys in the next one. Take care.